On a quiet Sunday evening in September 2008, the lights were still blazing on the top floors of Wall Street's most powerful banks. Inside, the titans of the financial universe were locked in a desperate last-ditch meeting to save the world. At the center of the storm was one firm, Lehman Brothers, a 158-year-old institution, a pillar of American finance that had survived the Civil War, 2 World Wars, and the Great Depression. In a few short hours, it would be gone. The decision to let it die was meant to teach Wall Street a lesson about risk. Instead, it triggered a global financial meltdown that burned trillions of dollars, destroyed millions of jobs, and pushed the entire world to the brink of a second Great Depression. This is the story of how the collapse of a single bank ignited a fire that engulfed the planet. To understand how this one bankruptcy could cause so much chaos, you have to go back to the years before the crash, a period of cheap money and dizzying optimism. In the early 2000s, the American dream was on sale, and the price was a mortgage. The housing market was booming, fueled by the widespread belief that real estate prices could never go down. Wall Street saw an opportunity to turn this boom into a gold mine. The fuel for this gold rush was the subprime mortgage, a new and dangerous type of loan given to borrowers with low income and poor credit, people who would have been rejected just a few years earlier. Lenders handed out these risky loans like candy at a parade, often with no down payments and deceptive teaser interest rates that would later explode. They weren't worried about the risk because they weren't keeping the loans. They were selling them to Wall Street investment banks, like Lehman Brothers, as fast as they could write them. This is where the story gets complicated because Wall Street invented a kind of financial alchemy to disguise this risk. First, they took thousands of these individual mortgages, some good, some decent, many truly terrible, and bundled them together into something called a mortgage-backed security, or MBS. Think of it like a giant smoothie. You throw in some good fruit, some okay fruit, and a lot of rotten fruit, blend it all together, and sell it as a healthy drink. Then they took the process a step further, creating something even more toxic called a collateralized debt obligation, or CDO. This was like taking the pulpy leftover sludge from 10 different smoothies and blending it all together again, creating a product of pure, concentrated risk. But how did they convince people to buy these toxic financial products? They paid the credit rating agencies companies like Moody's and Standard & Poor's to give them a perfect AAA rating, the highest possible seal of safety and approval. It was like a paid-for-food critic giving a 5-star review to a restaurant serving spoiled food. And investors all over the world, from pension funds in Norway to city governments in Germany, bought trillions of dollars of this repackaged American housing debt, believing it was as safe as gold. At the very center of this frenzy was Lehman Brothers. They were one of the biggest players in the game, buying and selling more of these mortgage-backed securities than almost anyone else. But they didn't just sell them. They kept billions of dollars worth of these toxic assets on their own books, convinced the party would never end. To amplify their profits, they used a terrifying amount of leverage. Just before the crash, Lehman's leverage ratio was over 30-1. That means for every $1 of their own money, they had borrowed and were betting with $30 of other people's money. It was an all-or-nothing gamble on a housing market that was already beginning to crack. The first tremors of the earthquake hit in 2007. The teaser rates on millions of subprime mortgages began to reset to much higher levels, and homeowners, unable to pay, started defaulting in record numbers. Suddenly, the mortgage-backed securities and CDOs that Wall Street had sold as gold were revealed to be worthless. The panic began. In March 2008, Bear Stearns, another major investment bank that had bet heavily on subprime mortgages, collapsed, and was forced into a fire sale bailout orchestrated by the U.S. government. This was a critical moment. The government had blinked, stepping in to save a major bank. This created a dangerous assumption on Wall Street, that certain banks were too big to fail and would always be rescued. It was an assumption that would prove to be fatally wrong for Lehman Brothers. The fate of the global economy was decided over a single weekend, starting on Friday, September 12, 2008. The U.S. Treasury Secretary Henry Paulson and the Federal Reserve Chairman, Ben Bernanke, summoned the CEOs of every major Wall Street bank to an emergency meeting at the New York Federal Reserve. The message was blunt and shocking. Lehman Brothers was out of time, and there would be no government bailout. The era of public money being used to save reckless private firms was over. The banks had 48 hours to find a private solution to save Lehman, or it would be allowed to fail. A frantic series of negotiations began. Bank of America was a potential buyer, but after looking at Lehman's toxic balance sheet, they walked away and bought Merrill Lynch instead. Barclays, a British bank, made a last-minute offer, but the British government refused to approve the deal without a U.S. government guarantee, which Paulson refused to give. By Sunday night, it was over. There were no more options. The government was going to make an example out of Lehman. In the early morning hours of Monday, September 15, 2008, Lehman Brothers, a firm with over 25,000 employees and $600 billion in assets, filed for the largest bankruptcy in U.S. history. The government believed the market could absorb the blow. They were catastrophically wrong. Letting Lehman fail was like removing a major intersection from the center of a global highway and expecting traffic to keep flowing. Lehman was connected to thousands of other banks, hedge funds, and pension funds around the world. When it collapsed, a wave of pure terror ripped through the financial system. No one knew who was exposed to Lehman's worthless assets, so banks stopped lending to everyone, including each other. The credit markets, the system that allows money to flow between banks and businesses, froze solid. This was the moment the Wall Street crisis became a Main Street crisis. The dominoes fell with breathtaking speed. AIG, the world's largest insurance company, had sold trillions of dollars in insurance on the very CDOs that were now worthless. It collapsed just days after Lehman and had to be saved with a colossal $182 billion government bailout. The Dow Jones Industrial Average suffered its largest single-day point drop in history. Trillions of dollars in retirement savings and pension funds were vaporized. With credit frozen, businesses that were otherwise healthy couldn't get loans to pay their employees or suppliers, leading to mass layoffs. The global economy plunged into a deep, painful recession, the worst since the 1930s. In the end, the government's tough stance lasted less than 48 hours. Faced with a complete meltdown of the global financial system, the Treasury Department and the Federal Reserve reversed course, launching the Troubled Asset Relief Program, or TARPA, $700 billion bailout fund for the very banks that had caused the crisis. The lesson that the government had tried to teach, that reckless behavior has consequences, was replaced by a much darker one. Some banks are so powerful and so interconnected that they can hold the entire global economy hostage. The collapse of Lehman Brothers was not just a bank failure. It was a failure of an entire ideology. It was the product of a decade of unchecked greed, a system where complex financial products were intentionally designed to hide risk, and a complete failure of government regulators who were asleep at the wheel. It's just a story of how the pursuit of short-term profits on Wall Street can lead to long-term pain for everyone else. And while new rules have been put in place, the fundamental question remains: have we truly fixed the system, or are we just waiting for the next bubble to burst? If you learned something, hit subscribe. Have a great day.